Hello, I'm Dr. Anthony Edwards, and this is a lecture for higher education leadership. And this topic is going to be about the basics of financial ratio analysis. So let's start with a basic question. So, what kind of information can you get from financial ratios? Well, I'm glad you asked. So, first thing you can get is information about liquidity and flexibility of the resources that an institution has. Second, you can get information about leverage, capacity, and management of a college's debt. You can get information about the performance and management of the assets of that college. And you can get information about how an institution accumulates and utilizes the funds that they have. So let's start with a little bit about terms that you'll see in finance as well as financial reports themselves. So first term you might see is fund balance. And so that typically is the difference between the revenues the institution collects and the costs. So if there's a difference, that essentially is the fund balance. So if you have a positive fund balance, that means you have more revenues than costs. Balance sheet, it's the next term, or report. So it's going to be a list of the assets and liabilities of that college. And liabilities essentially are different forms of debt. So you'll see balance sheet more in corporate finance, but in higher education, you'll see colleges use different terms. The private colleges usually call the balance sheet a statement of financial position, whereas the public colleges typically call the balance sheet a statement of net assets. All right, so where are you going to find information that you need? So you'll also see another form called a statement of revenues, expenses, changes in net assets, or statement of activities. So public colleges use that statement of revenues, expenses, and changes in net assets, and the private colleges use the statement of activities. All right, and that's where you find things like operating activities. All right, so how do we interpret these financial ratios? Okay, so questions that will help you to figure that out. First question, does that college have the resources it needs to support its mission? Okay, so ratios will help you determine that. Second question, are those resources flexible enough that allow them to use those funds in different ways in order to support that mission, or are they all restricted funds? So institutions obviously are going to prefer unrestricted funds that they can use in different ways. Does the strategic plan drive the performance as well as the management of that college's assets? Right? So is there a linkage between spending or the budget and the strategic plan? Ideally, there should be. Fourth question, is the college really living within its means? Is it managing its resources appropriately based on the operating results, right? Based on its cost and its income. Last question, does the mission of the college drive how that college manages its debt in particular? So making sure that organizations manage their debt appropriately is a really big deal. In the week of this recording, we actually found out about a college that is going to be closing, Birmingham Southern College, and we don't know all the details yet around why. There's speculation that it has to do with finances. There's information that they had tried to get financing and were unable to get financing because of their financial situation. So these are all important questions. All right, so obviously this chapter is about financial ratios. So we're going to organize these ratios into categories. Okay, so there's 4 basic categories. You have the liquidity ratios, the operating performance ratios, the debt and solvency ratios, and the source ratios. Okay. So let's start with the liquidity ratios. So there's three main liquidity ratios. You'll have the current ratio, the quick ratio, and the available funds ratio. So with the current ratio, the formula for that is unrestricted current assets, so things that you have essentially access to convert to cash quickly, divided by the unrestricted current liabilities, things that, the debts that you owe that need to be paid off quickly. Okay, so ideally you want a ratio there of assets to liabilities of 2-to-1. Okay, so anything lower than that may indicate you don't have enough assets that can be converted to cash to pay off those liabilities. All right, anything hugely greater than that might indicate that you're not putting some of those assets into maybe investments that might return a better return. All right, quick ratio. So here we're going to take the unrestricted current assets and subtract out the inventories, because sometimes the inventories may or may not be able to convert quickly to cash. Okay, and then divide that by the unrestricted current liabilities. And so here, because you're taking out the inventories, you can take a ratio that's closer to 1-to-1. Okay, so, and again, these are not hard and fast rules, but these are just kind of just quick analysis, to I guess pun intended here, to be able to determine the financial health of the institution. The available funds ratio then is just your cash and short-term equivalents divided by the unrestricted current liabilities. So again, first with quick ratio, we took out the inventories. Now we're taking out everything that's not cash and short-term investments. Okay, so here the ratio that's preferred is somewhere around 0.75-to-1. Okay, because then you've still taken out a lot of your other assets. All right, so current ratio, quick ratio, available funds ratio. These are your liquidity ratios. So these ratios rely on things like current assets and current liabilities. So what are current assets? Current assets, obviously, we talked about the cash and the cash equivalents. So that's like things in a checking account balance, petty cash, things of that nature. Accounts and notes receivable. So those things money that you should be receiving within the next, say, 90 days. Short-term investments like CDs, things like that. All right. Money market accounts, things of that nature. Inventories and prepaid expenses. So you can kind of see with your quick ratio, you take out the inventories, you still have the cash and cash equivalents, the accounts, notes receivable, short-term investments, and prepaid expenses. And then with your available funds ratio, you're just using the cash and cash equivalents and the short-term investments. So you've taken out the prepaid expenses and the accounts receivable in addition to the inventories. Okay. Well, now let's talk about the current liabilities. So things like accounts payable, things that you have to pay in the next, say, 90 days or so. Deferred revenue. So, if you have money that is coming in, but it's not coming in immediately, some of that revenue is deferred. All right. Current debt service. So how much it's costing you to pay off and manage a debt that you owe. So there's interest on that loan, if there are fees that are attached to it. Okay, so it's all part of debt service. Current capital lease service. So if you've got kind of, capital finance projects, large, like building funds and things of that nature, there's some lease service, or if you're taking on some things as far as a lease, that's a long-term lease for something, that, so maybe you're leasing a building and operating classes out of that building, or, leasing a parking lot or something, or parking garage, a residence hall, things like that. So it just depends on the nature of the financial arrangement. Accrued leave, so unused leave balances. So If employees have, say, a bank, your 2 weeks, and they get to, bank a certain number of hours every year, if they don't use that, that is accrued leave. And in a sense, like that still is owed to the person. And so it's an unusually balanced, but it's essentially not, it's essentially money that's owed to the employee if should they ever decide to use that fund or use those days, or if they leave that position and get paid for those days. So it's considered a liability. All right, so let's talk about operating performance ratios. So we have the net operating ratio, the revised net operating ratio, and the program or function ratio. So the net operating ratio is calculated by taking your operating revenues and subtracting your operating expenses. So operating revenues minus the operating expenses, and dividing that by essentially your total unrestricted revenues. Okay, so here, if you have a ratio of higher than 1, it indicates you have a surplus. So you've got money left over, all right, after you've taken care of your expenses. And if you have a ratio below 1, it means you have a deficit. Now, the challenge here is that the way a lot of colleges operate, they're always going to have a ratio below 1 because a lot of their income comes from non-operating revenues. Okay, so example of that are like state appropriations. So a lot of the state appropriations are, the way they're funded, they're not directly related to they're not always directly related to the operation of day to day of there's not like your appropriation based on your enrollment. So it's some funds are not driven by enrollment. So if you add those in, then you get a ratio of 1 or above. And so that's why we look at the revised net operating ratio. And that's where we look at total revenue minus the operating expenditures over total revenues. Okay, so that's the difference. All right, so here we're looking at total revenue and not just operating revenue. So third formula is the program or function ratio. So here we're looking at the expenditures by a specific program or the functional area of the institution and dividing that by the total expenditure. So that kind of helps you to see what percentage that area takes up in terms of total costs. And so let's just say, you can tell based on this that running student affairs takes up, 15% on that. Let's just say, or I'm throwing it as a number. I'm just saying it's X% of the total expenditures. Okay, so that's what that would be able to tell you. Now, the operating revenues, operating expenses, the non-operating revenues, you find this kind of information in the statement of revenues, expenses, and changes in net assets for the public colleges and the statement of activities for the private colleges. Okay, so just to let you know where to find that. All right, so what are the operating revenues? So tuition and fees, all right, federal grants, contracts, so as research is part of, the operation of at least for our universities, state, local grants and contracts, non-governmental grants and contracts, auxiliary enterprises, scholarship allowances, and sales and services. So remember, scholarships are considered a revenue piece because essentially, particularly if they, you have money that is coming to the institution from external, it's a revenue source, right? If it's an external scholarship. If it's an internal scholarship, it's usually a tuition discount. So we're still counting that on the revenue side because what we're essentially agreeing to is to accept less tuition. So it's considered a revenue. For operating expenses, you have things like student financial aid, all right, instruction, all right, that's, there's costs associated with hiring faculty members, things like that, research, costs associated with research, public service. A lot of universities are engaged in some form of public service, whether it's public radio or things like that. Academic support and student services. So it costs money to have tutors. It costs money to have academic advisors, right? So physical plant, making sure that there's electricity, air conditioning, all of those things. There's costs for that. All right, depreciation. Okay, so here you're depreciating the cost of of an asset over time. So there's cost about that, but you're just taking out a certain percentage over time. But each year that cost is an expense. All right, so we talked about the operating revenues. Let's talk about the non-operating revenues. Like I said, we talked about the state appropriations, gifts, so charitable giving, fundraising, those things, investment income, non-operating grants, and contracts. So these sources of income can, particularly in the case of universities, can be quite large. All right, and so again, that hints to why that revised net operating ratio is important. All right, let's go into the next category of debt and solvency ratios. So here we got three ratios again. We have the debt to equity ratio, the debt to service ratio, and debt service burden ratio. So for the debt equity ratio, it helps us to determine college's ability to be able to access or get long-term credit and debt based on its expendable net assets and current debt levels. All right. So again, I go back to the case with Birmingham Southern. There was a case a few years ago with Sweetbriar College. There's some others that have been closing in recent years. But particularly in the case of Birmingham Southern College, they tried to access some debt from the state of Alabama, and apparently there were those in the public government in the state of Alabama who didn't feel like the institution was a good credit risk. Okay, and so I don't know whether they analyzed the debt to equity ratio, but I would imagine that was one of the things that they looked at. But again, I'm speculating. I don't know that for a fact. So, all right. Here, a ratio 1-to-1 is considered ideal. All right. So since you want to have enough collateral in your equity to back up any debt that you have, just in case you weren't able to pay that debt. So you have a matching asset, to be able to pay off if you need to pay it off. So with the debt service ratio, here we're looking at the debt service costs and dividing that by total revenue. So, since you're taking the money that you're bringing in, that's your total revenue, and then looking at how much you're paying to, essentially to finance your debt, and then saying, okay, well, of the money I have available to pay it, what percentage of that is going to be taken up by the debt service? Okay, so understanding that's important. Now, you also can look at the debt service burden ratio, which instead of looking at the total revenue, you're going to divide debt service by total expenditure. So you're saying like what percent of your total expenses is it? And 10% is usually considered a good rule of thumb number. 20% is kind of like your limit to be able, if you're going past 20, it's considered that's way too high. Right, so you don't want to be spending 20% of your budget on debt service. That's considered to be way too much. All right, so it's similar to buying a home or buying a car. You don't want to be spending a huge percentage of your monthly budget, the money that money that you have access to from your job or your business, and you're paying all of that out in your mortgage payment and your maybe a car payment. And so you want to be able to at least have money, cash in reserve, to be able to not if you're paying more than 20% of your income, in that, you may say in this market, how could you not do that? But, we typically want colleges to be, more on the conservative side. So they don't end up in these situations where these colleges are having to close their doors. All right. Let's see. I do want to look at the source ratios. So for the source ratios, you have the contribution ratio. And that contribution ratio is the source of revenue divided by the total expenditures. So you're looking at, money that's coming in, and you're comparing that to all of your expenses. Okay. So basically what it's telling you is X percent of your expenses rely on this other revenue source. So if you're, let's just say in the case of community college, 60% of your, let's just say, you have, this budget, and let's match up, budget money that you're getting from property taxes, and you're comparing that to your total expenses. I would expect the money that's coming into that community college from property taxes to take up a pretty sizable chunk of the total expenditures. Okay. And so that's just kind of gives you another way to see how the different revenue sources contribute to paying your expenses. All right. So the importance here is on diversifying your revenue sources. So when those percentages for certain things get really high compared to previous years, that tends to show that you're getting a lack of diversity in your revenue source, or other sources are drying up. So if certain funding sources as a percentage are going up, then others are going down. So you got to figure out why those other ones are going down. Also, it's important to be flexible. So and that's kind of another way of looking at diversification, but being able to kind of transition. When you have diversity, you can be flexible, right, with how you're getting your, the money. Increasing your use of restricted revenue sources can indicate that there's some challenge going on. So, essentially, if you're having to only rely on your restricted funds, that means you're not getting on unrestricted funds, right? And so, in a sense, the thing that a lot of colleges are after are the unrestricted funds, and trying to figure out how to get more of those. So, because again, with restricted funding, you can only spend it on certain things, but you may have other things that cost money. And if all your money is restricted, even if you have, let's just say you have enough total money to pay for something, but you can't use that money to pay for something, then in particular, it's almost like not having it. Okay. So you have to have some other unrestricted, because there's general things like general, maintenance of the institution, physical, you may have funds that you have to pay for electricity. You got to pay for administration building, people who work in administration, there's things that, you have to have at your institution that don't necessarily, it may not be what someone wants to write a check for. Like most people don't want to write a check for the people who work in the administration building, but you have to be able to pay them. Right. So, so that's important to be able to have flexibility in your revenue sources in restricted versus unrestricted. All right. So now that we've talked about the ratios, I want to caution you not to just just run with that and just say, okay, here I have these numbers, therefore I can tell you everything there is to tell you about this institution. Let's back up a little bit. So make sure you're using the financial ratios along with the financial statements, because again, numbers, there's a statement, numbers don't lie, but numbers are all about context. And if you use the ratios without the context of the statements, there may be information that you're leaving out. Also, making sure that you're able to look at multiple years of data. And the reason I say that, because you may look at 1 year and you say, this data looks bad. But if you look at the year before, maybe it was even worse. And you might be spotting a trend moving in the right direction. All right. So you have to be careful. Looking at one snapshot in time may not give you all the information you need. And you may not know necessarily like what changed about the institution. So you may look, okay, here's what things looked at in 2023, but you may compare that to 2020 during COVID years, and the enrollment was extremely different. And then you may compare that to 2018 pre-COVID, and again, very different situation. Numbers may look different, and so you got to be able to look at the context. Also, don't put all your eggs in one basket. Don't put all your stock in one ratio. You may have the ratio that you like the most, but make sure that you're looking at a variety of ratios from a variety of categories so you can get a well-rounded picture. Also, a lot of colleges today, they have things like college foundations. They may have auxiliary enterprises. If they run a hospital or something like that. They may have other entities that are associated with the institution. So make sure that if that's the case, that there's some note made of that in the financial reporting. So folks can go and look at the records for that institution and really getting a holistic view of what the total picture is. Because if not, because there's sometimes there's expenses or revenues that are carried on one side, not the other. And so it just helps you to have a full picture. So hopefully this gives you a broad scope to understanding financial ratios. My goal in this is, most of you who watch this video, your goal is not to be a college CFO. It might be, but many of you, your goal is to be a higher ed leader. So just understanding the ratios, understanding financial statements in general, understanding budgets in general will help you progress as a leader. And also just want to demystify it so you're not scared of it. All right. So if you found this video helpful, please like, subscribe, and share. And for those of you in class, I look forward to interacting with you in the discussions. I also encourage you to look at, particularly at the end of this chapter, questions 7, 8, and 9. Try to answer some of those questions and calculating the financial ratios and responding with some of that information in your discussion post this week. Look forward to hearing from you. And thanks so much, and we'll see you in the next video. Bye.